you're concerned about the upcoming recession and what it will do to your HELOC, and you're concerned and you're worried, well, stick around because I'm going to share some practical tips as well as some awareness as to what you can do to shield yourself and your HELOC during the recession. Hey, what's up, you guys? This is Kwak here, one of the Kwak brothers, real estate investor, and chances are you may have watched my video on how to pay off your mortgage within 5 to 7 years on average without ever having to add more money or cut back on your expenses. And by now you know you have to get a HELOC, but you're concerned because you sense a recession coming along and you're wondering, well, I don't know if I want a HELOC because there's a recession. And I've heard of horror stories back in 2008 and 2009 of people losing their homes and their HELOCs being shut down. And I don't know if I want to get into that situation like we saw in 2008. This is something I get a lot, quite frankly, and I had to make sure that I address this for all of you guys and how to properly prepare for an upcoming recession, even if there is. Now, I do believe that recession is coming, and the best way to prepare for that is hit the like button. I'm just kidding, but do hit the like button and turn that like button blue because it helps a lot of people out there get prepared for a possible upcoming recession. So let's dive right in, but before we do, we have to set the stage as to what actually happened in 2008 and why are people so concerned and worried. Well, back in 2005 through 2007, which is where we really saw the ramp up of this crazy madness of this financial disaster we saw in 2008. Well, what happened between 2005 to 2007 was that the banks were getting super lenient. They were pretty much careless as far as who they were giving their mortgage to. So people who didn't have the best credit score, people who didn't have the best income or the best documents, or they didn't even have a job, people were getting mortgages. Now, here's the crazier part. I'm going to draw this out for you guys in this amazing screen here. People were going out there and getting their mortgage. And keep in mind, people didn't quite deserve to get a mortgage with the financial situation, but they were getting it anyways. So they were getting a mortgage with 80% loan to value, meaning that if your home is worth $100,000, the banks were giving you and financing you 80% of the $100,000 value, meaning $80,000 loan. So people had to come up with 20% down, right? And we thought that was going to deter some people buying homes. Well, think again. Banks got creative. They said, you know what? If you can't afford that 20% down, we'll lend you that 20% down. And so what ended up happening was they were getting another mortgage on top of the 80% loan. And of course, the banks were providing that 20% down on a loan, which of course today we look back, this is crazy. Obviously, $100,000 value home, $100,000 debt, right? 100% maxed out, which is not good. Now, we think that this is crazy. Well, think again. Banks are getting even more crazier. The bank said, you know what, on top of that, we're going to give you a bonus, and we're going to give you a HELOC on top of that. And keep in mind, guys, the concept of HELOC was relatively new. I know it's been around for about 20 to 30 years, but at that point, it was still relatively new, and people really didn't know what that was. So they were like, okay, it's extra money. We'll take it. Come on, bring it over, right? So not only the banks were giving the 80% loan to value, they were giving you a second position mortgage and a third position HELOC, which first, second, and third, this is a terrible mess. So what ended up happening was that people were banking on the fact that their home will probably end up being not only $100,000, but it'll be $120,000 next year, right? People were sort of gambling. They were saying, yeah, my home was worth $80,000 last year. It's now worth $100,000. Well, next year, by logic, it's going to be $120,000. And that's what people were banking on. They were like, oh man, the value of the home is going to go up, so it's okay. I can get in more debt. It'll catch up. Well, that's the fallacy that we fell in. So after 2008, the home value just tanked and dropped depending on where you were. It just, it fell like a rock. Let's say this $100,000 value home, okay, now after the recession is $80,000. Well, guess what? You owe $100,000 plus any portion that you use on the HELOC, but your home value is $80,000. So effectively, you owe more than what your home value actually is. And the problem with the HELOC was people weren't using the HELOCs to pay off their mortgage. Guess what they're doing? They're going out to Vegas, they're buying a new boat, they're buying a new car, they're doing some stupid, ridiculous things, and that's the problem. And this is why Dave Ramsey is so against HELOCs, because that's what people were doing. They weren't disciplined, they weren't using our strategy. They were going out there and jacking their loan up to 100%, 120% of the actual home value, and that was the issue we saw in 2008. Now we can go deeper and go into the detail as to what actually caused 2008, but let's look at the consequences, right? Most people saw this major drop in their home value. So this is where the fear comes from. People lost their HELOCs and people lost their homes. They couldn't pay their mortgages. They couldn't pay their second mortgage. It got really bad. And banks were freezing or shutting down the HELOCs completely because of the home value dropped so steeply, and banks were taking away HELOCs. So this is the fear. Now, here's how to prepare for the next recession and what to actually do with the HELOC. And for those who don't know our strategy on how to pay off your mortgage within 5 to 7 years on average, we accomplish that through using a HELOC. And if you guys are wondering, oh, I need some more explanation on this, well, go and click on this video right now. Bam, there it is. Click on that video. It's a 25-minute explanation video on how to pay off your mortgage within 5 to 7 years without adding more money or without cutting back on your expenses. Now, if you enjoyed this video so far, again, just a reminder, go and hit the like button, as well as subscribe to our YouTube channel for more awesome information. Moving forward, I do believe that there is gonna be a recession coming soon. We're due for a recession. It's gonna happen. Who knows? It's already happening right now, but we just haven't felt it all the way yet. So here's my recommendation, or at least my opinion. Okay, I don't give any financial advice, it's just opinion. My opinion is that keep your debt level below 70%, meaning if you have a home value of $100,000, keep your debt level within $70,000 or less, right? Preferably less, right? We don't want to be in too much debt. And that also includes combined debt. So if you have a mortgage and a HELOC, make sure you go below 70%. Now, if you're over 70%, let's say you're at 90% debt compared to your total home value, our strategy is probably going to be the best quote-unquote weapon to get you down to 70% as fast as possible. Of course, this is achieved by not getting into more debt. We don't want to buy a new car. You don't want to buy a boat, right? Those are terrible things to buy. Fun, but not the best financial decision that you'll make. Make sure you stay below 70% in terms of your total debt. Another practical tip that I want to share with you guys, an opinion, is when you do use a HELOC, keep it within less than 30% of your HELOC limit. So here's what I mean. Let's say you have a $50,000 HELOC limit that you're given, okay? Remember, HELOC works similar to a credit card, and you have a limit, not the total loan. My recommendation is use only 30% of this $50,000. Okay, so less than $15,000, right? Because what happens is, well, two things. Number one, this also helps you when it comes to keeping that debt level below 70%. Number two, because a HELOC is a revolving line of credit, if you exceed 30% limit as far as usage of your credit, it may actually have a negative impact on your credit in terms of your utilization rate, which, if you guys know, your FICO score, approximately 30% of your FICO score is about the utilization. How much of your credit are you actually using? Now, some banks actually may report your home equity line of credit as a installment loan, which in that case, it won't have any effect on your utilization and your usage on your credit and your FICO score. The third thing that I want to share with you guys is keep the communication and the relationship going with your lender/bank. I mean, nothing is ever worse than getting into a recession and your bank doesn't know who you are, right? Because banks are going to start to make some moves when there's a recession. They're going to try to protect themselves, protect their money. And the worst thing that you want to do is turn your shoulder on the banks. So what you want to do is build that relationship with your banker, build that relationship with your bank, because what happens is you want to make sure that you leverage that relationship. If there is a recession coming on, you'll be able to have a communication or a conversation as far as negotiating the HELOC or modifying your loans, or you want to make sure that you have plenty of safety net if there is ever a big trouble looming ahead. So I hope that this gave you guys some practical tips as well as some awareness as to what you can do to protect yourself with your HELOC during the next recession. Now, again, if you guys felt like you got a ton of value from this, guys, be sure to hit the like button as well as subscribe to our YouTube channel and hit the bell icon so that you get notified for our future videos. Guys, stay safe, stay educated, and I'll see you guys in the next YouTube video.